So as we now face some uncertainty in the world economy, and we saw this last time during the 2008 global financial crisis, expat New Zealanders look to how they can come back to New Zealand and resettle here. One of the questions that arises is, where does the tax come from? Because let's face it, you don't move on the 31st of March every year. You move transition during the course of the year. Now, we have a worldwide income approach in New Zealand. Effectively what that means is that you need to take your taxable income from every source that you generate income from. Now that could be, for example, from shares overseas in America. It could be from investments you might hold in the United Kingdom. It could even be distributions from trusts based in the Cayman Islands. The reality is all of that stuff needs to be captured for tax purposes in New Zealand. But fear not, it's not as bad as it might first sound. Let's say, for example, that you earn $10,000 in dividends from a United Kingdom company, UK. Then you also earn another $10,000 from interest in the United States. And then you earn another further $30,000 in New Zealand from local sourced income, PAYE, deducted earnings. How it works is your total is $50,000. That $50,000 is taxed in New Zealand, and the tax on that, let's say it's around about $11,000. But two lots of this income will actually have tax credits attached to it. So, for example, in the US, the interest rate might be 10%. Oh, sorry, the RWT rate is 10%. So on $10,000, you've got $1,000 of US paid tax, which offsets against your New Zealand income. The UK might have something, and I'm not sure to be honest, but I know Australia has franking credits and we have imputation credits. Both of those tax credits are not available on your foreign sourced income. They're only available to local sourced income. But often foreign dividends will have another 10 or 15% DWT added onto it. So if we use 10% on dividends from the UK, there's another $1,000 that's come off that dividend. Now on your $30,000 of PAYE deducted earnings, your PAYE on that should be around about $3,500. So we take $3,500 off that bottom line, you've now got total tax of $5,500 off the $11,000. That would result in additional tax to pay of $5,500. Now, these figures aren't exact figures, but they're designed to give an illustration of how your overseas sourced income, which has tax at source, is offset against New Zealand. The question is, these only apply where we have a thing called a double taxation agreement. This is an agreement between our sovereign government, New Zealand, and the overseas sovereign state. For example, we've got one with Japan, Australia, New Zealand, of course we have one with New Zealand, the United States, and also with the United Kingdom. But there are many, many others as well, and they're signed up all the time. The question is, when we don't have a double taxation agreement, any tax paid at source cannot be offset against your New Zealand income. So you need to be careful when you're bringing income back in from overseas, where you're bringing it from, and making sure that any tax paid at the source of that country is able to be offset against New Zealand's source. Because while tax may not be allowed to be offset, the income, gross income generated in that jurisdiction does need to be returned. And an example could be the United Arab Emirates, which doesn't have any tax or a very low tax jurisdiction. We don't have a double taxation agreement. As the income comes in, it would mean that the gross income needs to be returned, but there's no tax advantage or tax remission offsetting against the tax payable in New Zealand. So it is important, if you're looking at any overseas income, to talk with your advisors to make sure you have a double taxation agreement to help with that locally sourced tax coming back into New Zealand.